In today's market update, we're going to be taking a look at the 80-day cycle trough that has formed in the S&P 500 and other stock markets, as expected, and asking whether the speed of the move out of that 80-day cycle trough questions our bearish outlook presented in last week's market update. Here is the analysis we've been looking at in the S&P 500 or SPX for some time. As you know, we have a prominent 18-month or possibly 54-month cycle trough in October of last year. We have been discussing recently the 40-week cycle trough, which according to this analysis is positioned over here in the middle of August. There has been some discussion about where that 40-week cycle trough should be correctly positioned, and in recent market updates we've considered the possibility that it came in early over here in July, or formed in August as is shown in this analysis, or possibly even was going to form very late. Last week I discussed the fact that the 80-day cycle trough was due and that it was very likely going to form, either had formed the week before or was going to form within the first few days of last week. As you can see, we had a strong move out of that 80-day cycle trough. And so there is no question about the fact that an 80-day cycle trough has formed in this market. The only question is whether that trough is also a late 40-week cycle trough that has formed in this market. So let's consider the possibilities. First of all, why is it more likely that the 40-week cycle trough formed here in August than that it has formed recently over here at the end of October? That has to do with the number of bars that have elapsed in this potential 40-week cycle. If we measure the number of bars from the October 2022 trough, you will see that 379 bars or 379 days elapsed into that trough at the end of October. Now, the average length of a 40-week cycle is 272 days. That is the average length discovered by Hurst 50 years ago, and it continues to be a very reliable average length of the 40-week cycle. Now, these cycles are dynamic. We know from the principle of variation that the wavelengths of these cycles are constantly varying. Is it possible that this 40-week cycle extended long and has played out over 379 days instead of 272? That brings up the question of what is an impossible wavelength. I've discussed this before, but when it comes to a Hurst cycles analysis, we very rarely say impossible or use the word never. It is possible that the 40-week cycle did stretch to a length of 379 days. That would make the cycle about 40% longer than the average wavelength of this cycle. As a general rule of thumb, I allow about a 50% variation, and so at 379 days it is still within the realms of possibility that this could be a 40-week cycle trough. However, it does create an anomaly in this analysis, and that has to do with the position of this 20-week cycle trough that we have recognized for some time as having formed in the middle of March. We had a very clean and clear M shape that played out over that 20-week cycle. That cycle was in itself fairly long, at a little bit over 150 days, as opposed to the average 136 days for the 20-week cycle. So where is the anomaly? If that was a 20-week cycle trough, as seems very likely, then that means that the second 20-week cycle that formed the 40-week cycle would have had a wavelength of 228 days. Really is very long. As I mentioned, we rarely say impossible or never when it comes to Hurst cycles analysis, and so it is still possible, but it seems very unlikely that the 20-week cycle would have stretched so long. Nevertheless, we must stay aware of the possibility that the trough that formed at the end of October is also a trough of 40-week magnitude. How would that affect the long-term bearish implications that I pointed out in last week's market update? It is very important when discussing a Hurst cycles analysis that we bear in mind the time frame that we are discussing. And in last week's market update, I took a big step back and I considered the bigger picture by looking ahead several years. And so the possibility that the 40-week cycle trough came in late and formed at the end of October doesn't really make a big difference to the bearish outlook that I was discussing when looking ahead many years, but it certainly does take the edge off it. What do I mean by that? Well, the immediacy of that potentially bearish outlook was caused by the fact that we had just witnessed a bearish 80-day cycle shape in this market. That, of course, has not changed. That is a bearish 80-day cycle. If this is a 40-week cycle trough that formed at the end of October, then, of course, we would expect a bearish 80-day cycle in this position. If, however, the analysis shown on this chart is the correct one, and you can see that I am still displaying it, Sentient Trader prefers this analysis over any other option, then the bearish shape of that 80-day cycle brings some immediacy to the question of the bearishness of this market. Because if that is the first 80-day cycle following a 40-week cycle trough, that has very bearish implications. If, however, it is the last 80-day cycle in a 40-week cycle, then the bearish implications are not so immediate. But the possibility that the 40-week cycle trough did not occur there in August, but instead occurred over here at the end of October, does not change much else about this analysis. All that it does do is it will push the 20-week cycle circles over by one 80-day cycle, and it will also, of course, push the 40-week cycle circle over by one 80-day cycle. This 18-month cycle circle, which is telling us when to expect the next 18-month cycle trough to form, does not move at all. And if what we see before us now is one 40-week cycle, the fact remains that the next 40-week cycle is expected to be less bullish than the previous one. The immediacy of this bearish 80-day cycle has been removed from the equation, but we are nevertheless expecting a turn towards the bear as price comes in to this 18-month cycle trough expected in about the middle of next year. So how are we going to monitor this situation? We are going to monitor it in the way that we always monitor the way in which cycles play out in the markets. We are going to consider whether price targets generated by the Hurst cycles tools are met or exceeded, or whether price fails to reach up to those targets. And so here is our 80-day cycle trough that formed at the end of October. It formed 70 days after the potential 40-week cycle trough that we identified in the middle of August. Bear in mind that the average length of an 80-day cycle discovered by Hurst 50 years ago is 68 days. And so at 70 days, that provides us with a very appropriate cycle wavelength for the 80-day cycle. The first thing that price did, of course, with regards to the 20-day cycle FLD, is price crossed up above the 20-day cycle FLD over here on Wednesday. Measuring the point at which median price crossed the FLD, we could generate a target of 43.55. That target was reached on Friday. It has been ever so slightly exceeded, but not dramatically yet. Of course, price might keep moving upwards and far exceed that target. Why is it important that it might exceed the target? Because in a balanced market, we would expect this first interaction between price and the FLD following a trough of at least 80-day magnitude to be met, after which time we would then expect price to turn down and come back towards the FLD and find support at the level of the 20-day FLD at about the time that the 20-day cycle trough forms in the market. Now that 20-day cycle trough is now expected on about the 14th of November. And again, in a balanced market, we would expect price to find support at the level of this FLD. And so in terms of monitoring the price action as it bounces out of this cycle trough and trying to decide whether we are witnessing an 80-day cycle trough or a bigger magnitude 40-week cycle trough, we are going to be closely watching the way in which price behaves. If price exceeds this target by a good amount, that would indicate that there is more bullishness than would be expected in a balanced market. Are we expecting a balanced market if the 40-week cycle trough formed in the middle of August? No. As mentioned in last week's market update, the fact that we experienced a bearish 80-day cycle following that trough in the middle of August would indicate, if that trough was a trough of the 40-week cycle, that the markets have turned bearish. We are therefore not expecting a balanced cycle here, but in fact a bearish one. The fact that price reached up to the target generated by it crossing the 20-day FLD so quickly is our first indication that this might not be the bearish cycle that we expect. It doesn't entirely negate that possibility, but it does certainly raise the question. And so we are going to be watching to see whether price far exceeds this target, or whether it does in fact turn down now and come down to the 20-day FLD. As it reaches that 20-day FLD, we will be watching with interest to see whether price finds support at the level of the FLD. If it does find support, or even find support above the level of the FLD, then the bullishness of this market will be confirmed, and the possibility that this is a 40-week cycle trough that formed at the end of October will be increased. Because of the bullish signs provided by this market, we will continue to monitor the unfolding cycle shapes as they play out in this market to further inform our analysis. And so in the short term, we have a potentially bullish situation with price bouncing with great enthusiasm out of a trough that is definitely of at least 80-day magnitude, possibly even of greater magnitude. But in the longer term, we are still keeping an eye on the fact that the markets are expected to turn bearish, to bring us down into an 18-month cycle trough expected in the middle of next year. As a matter of interest for those of you who have studied the FLD trading strategy, you know that when price bounces out of an 80-day cycle trough, we, as a general rule, enter into these trades even when we are expecting a longer-term bearish outcome. The reason for that is because when there is an anomaly in our analysis, or when we have made a mistake with our analysis, the most likely mistake that we have made is in either underestimating or overestimating the magnitude of a particular cycle trough. We were not worried in this situation of overestimating the magnitude of this cycle trough because of the fact that we had a very clean M shape coming into this potential 80-day cycle trough. And counting the days that had elapsed since the fairly obvious trough in the middle of August, we had 70 days, which is, as I've mentioned already, very close to the average wavelength of an 80-day cycle. And so we were certainly expecting an 80-day cycle trough to form. When trading interactions between price and the FLD, we recommend placing a trade when you have a high confidence that your sequence cycle, in this case the 80-day cycle, has formed a trough in the market, even if your underlying trend is potentially bearish. The reason for that is because your calculation of your underlying trend would change if you have underestimated the magnitude of this cycle trough, which potentially we had done. So far, we have seen only the first of the moves out of this 80-day cycle trough. We then have the move down into the 40-day cycle trough expected over here at the end of November, and then of course the 20-week cycle trough expected early next year. As we witness this cycle shape unfolding, we can clarify our understanding of what the magnitude of this cycle trough really is. It is certainly a trough of at least 80-day magnitude, but possibly even greater. If this turns out to be a trough of the 40-week cycle, we would expect a bullish 80-day cycle to play out now. However, if the 40-week cycle trough did form in the middle of August, we would expect this to be a bearish 80-day cycle with an early peak and then, of course, price moving down into a lower 20-week cycle trough expected at the beginning of next year. The next critical moment for us to watch very carefully is what happens as price approaches the 20-day cycle FLD at about the time that the 20-day cycle trough is expected to form, in other words, early next week. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below this video or join us on our Hurst Cycles Discord server. I look forward to hearing from you.